All right, good Wednesday morning. Slight gains again. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. You are watching Bloomberg Open Interest.
Coming up, Macy's delivers a beat, but profit forecast, the profit forecast it gave underwhelms, sending shares falling.
Marvell surges on a bullish AI chip order, adding fresh fuel to a big week of AI earnings.
And the White House is ready to tear up President Biden's fuel economy standards. We'll tell you what it means for car makers and consumers.
First, I want to show you what Marvell is doing, the AI chip maker that I mentioned, because it's another company that has earnings and basically is like, yay, everything is great because AI is great. For them, it is their technology used for AI data centers. They say that the revenue for that is expected to jump 25% next year. So shares are up 9% in the pre-market. It also announced an acquisition of Celestial AI for more than $3 billion. That does like something with photons instead of electricity. I'm sure Caroline Hyde can describe it to my puny little human brain.
She definitely knows. I want to check out some some retail movers here. Dollar Tree, I guess it's kind of a deal, raised its outlook as it expects to see more spending from stretched shoppers looking for discounts. Macy's shares are sharply lower despite earnings beating estimates in the trailing quarter and lifting its outlook for the future as the CEO says it is well positioned for the holiday season.
Let's get more on Macy's, Matt. We are joined by Bloomberg host Romaine Bostick, who spoke with the retailer CEO Tony Spring earlier this morning. Romaine, thanks for joining.
Yeah, Dani. Did you do any shopping?
I did, but not at Macy's. I got to be honest.
Yeah. Well, I mean, the interesting thing, I did ask him a lot about what foot traffic was. Was there an actual increase? He did say he was happy with foot traffic, but he also seemed to imply here that a lot of the revenue gains that they've seen in this most recent quarter was people buying more. So basically, bigger tickets, bigger receipts, if you will, rather than actually more people going in there. But this is also a company that is, he's doing the conference call now, and he's been asked a lot about how strong this holiday season is going to be. And one of the reasons why you see the shares down a little bit here is the comp sales growth, while certainly an improvement over previous years, is still kind of lagging what you would have seen at a company like Macy's in holiday seasons of past. Remember, this is going to be, or supposed to be, their best quarter of the year, their fiscal fourth quarter.
Going to a physical store seems like a quaint idea, but a strange thing to do, right? I mean, most of us buy all of our stuff online. How are they doing with that?
Well, I mean, first of all, the average age of a Macy's shopper is over 40. It's like, late 40s, I think is the average age. So that gives you a sense of one of the challenge that they're going. I know, Matt, and you're still in your 30s. But it gets to this idea here that there is still a cohort of boomers out there that do want that physical experience. Macy's obviously is now trying to make sure that their younger generation of Gen Z and beyond, that they are actually engaged in the physical stores and trying to make them more experiential. That's the long-term story. And that's what he's doing. He's basically taking 350 Macy's stores, basically going to revamp all of these stores to make them more experiential. He's only done about 125, 150 so far. They're going to get to the rest over the next year and a half, 2 years.
It feels like we're in this bizarre world where the retailers who do well, it's because you've got like Sydney Sweeney to do your campaign, or Cat's Eye, or some sort of celebrity. I mean, Macy's isn't doing that, but it feels like we're in this weird era of collabs and influencers.
Well, it's interesting. And you bring up, obviously what we're seeing with American Eagle. Their shares on fire. I think when they open, they're going to be having their best day in a couple of months. But it gets to this idea, that's a singular brand, right? And Macy's is a multi-brand retailer in an era where a lot of us go directly to the brands themselves. We connect with those brands either because, Matt salivates over Sydney Sweeney in that ad or something else. And the question is, how does Macy's sort of, get that fire? They've had a lot of collabs with Wicked and other things like that do get people into the stores. But it's a much bigger challenge, Dani.
Material Girl. Apparently the fashion brand of Madonna sells exclusively at Macy's.
Ooh.
Yeah, and they've been doing a lot more exclusive
fingerless
deals.
Gloves for that kind of thing.
Their own private brands as well, trying to get people in there as well too, Matt.
Ryan Seacrest is working with them. Are there any of these celebrities hitting home with you?
I would never be like, I love Ryan Seacrest's look and I want to wear his clothes.
All right, Romaine, thanks very much. Looking forward to the close. Romaine Bostick, of course, anchors the close with Katie Greifeld at 3 o'clock every day. Number of AI movers this morning, as usual. Marvell climbing as data center revenue jumped more than 25%. Okta's results and forecast were seen as underwhelming. As a result, that stock is down, and CrowdStrike is wavering despite raising guidance thanks to momentum for its AI products. You can see those shares down in the pre-market as well. Joining us now is Bloomberg Tech co-host Caroline Hyde to talk about, I guess Marvell is really the focus, right, because of the big gains that we're seeing there.
You salivating over this $80 billion company?
Oh, yeah.
Only 80 billion.
Sexy.
The thing with Marvell is that actually its stock's been really hammered this year. It has been worried about macroeconomic uncertainty. It has been under pressure. It's up by 15%. But today we might push it if we cling on to some of these gains, at least make some headway to erasing that loss on the year. Marvell makes chips for other people, like Amazon. Look, we just heard all about Trainium 3 and the ASICs, those custom chips that all these hyperscalers want. That's where the enthusiasm is coming more broadly for Marvell, the fact that they are going to start to be important in your servers, in your AI accelerators, in storage. And the CEO sounded really buoyant about this. Remember, they're also splashing their cash to the tune of up to maybe $5 billion for Celestial AI. This is a startup in California, built in 2020. This is about the edgy area of photonics. It's about using lasers instead of electronic signals to make all your data move faster within a data center. Lasers. Who doesn't love lasers? And this is a purchase that initially is going to be $3.25 billion, part of that cash, part of that stock. But if they hit some certain revenue targets, then they could get as much as $5 billion. That's a nice, tidy upside from the raise that they did back in March that valued it at just over $2 billion.
It's not a profitable company, Caroline, and it speaks to this narrative shift that keeps happening so quick in this AI era. I'm looking at an information story that just came out that's hammering Microsoft shares. They've lowered their AI sales quota because customers have complained that they can't actually measure how much they're saving from using AI. How difficult is it to ascertain just how much value we're putting behind these companies and whether or not that's justified or not?
Look, this is why the healthcare sector is outperforming since the bottom of the market and why the tech sector is lagging, because still we want to understand the bang for the buck, the productivity that you're going to get. I spoke with Michael Dell yesterday after his big $6.25 billion contribution from a philanthropic perspective. I asked him about AI bubble. He's still really certain that at the moment the market is going to go higher, that we are going to see real productivity gains. But it's hard to measure. You've got to believe in these things. And also you've got to train and reskill your own workforce to be able to adopt the latest co-pilot that's being measured. But suddenly we've heard from the hyperscalers that the demand is bigger than supply. Issue for Microsoft is it needs to build more data centers to be able to really maximize that Azure growth, same as we're hearing from all of the other key players.
Yeah, it's been a problem that they've talked about, probably a good problem to have. Caroline, thank you so much. That's Bloomberg Tech's Caroline Hyde. All right, let's turn to this morning's data where U.S. companies shed payrolls in November by the most since early 2023, according to ADP data. Joining us now is Bloomberg economist Stuart Paul. And Stuart, the numbers look even worse if you look at small businesses and small companies, whereas companies with more than 500 employees added to it. So what's more important, the fact that the big are thriving and adding people, or the fact that if you are a small company, you're in some serious trouble right now?
When small businesses are struggling, it speaks to a lack of economic dynamism, a lack of dynamism broadly in the labor market. So I do index more on what's going on with some of these small businesses. Regionally, it was also very concentrated. The layoffs were mostly in the Rust Belt states, Michigan, Wisconsin, and so on. And when we look at the industries, it's interesting, a lot of layoffs in manufacturing, and then to just build on the AI story we were just hearing about, how difficult it is to identify some of the cost efficiencies that come from AI. But we are seeing layoffs in things like the information industry and in professional and business services. So it might be difficult for firms to measure some of these productivity and efficiency gains, but they are making hiring decisions seemingly on the basis of possible efficiency gains in the industries most exposed to AI.
So the fact that they're not hiring as much, or companies that are doing layoffs, doesn't have anything to do with restrictive rates, does it?
I don't think so. I think that a lot of these changes are structural changes.
Because you get where I'm going, right? Rate cuts aren't necessarily then going to help.
Yeah, I think that a lot of the layoffs and the slow hiring that we're seeing are an adjustment to bigger structural forces, things like AI and a reshuffling of the global commercial order as a consequence of newly implemented tariffs. We also saw import prices earlier this morning. They're old, it's September data, but it does look as though in that report China is passing along more of the cost of tariffs and bearing less of the incidence of tariffs. So there is this reshuffling that's going on, and I think that it is a consequence of big structural changes, and so I don't expect rate cuts to matter much, but U.S. households and firms have been insulated from the effects of monetary policy since the hiking cycle began. So I think that that's just where we are. These are big structural forces.
By the way, the other structural force, along with the changes in technology, is immigration, too. And that's something that rate cuts aren't going to impact either. So what's the logical conclusion to this? If you have Fed governors coming in, and by the way, it seems more and more likely each day passing that Trump is hinting that Kevin Hassett might be the next Fed chair, so very dovish Fed chair. What happens if you get cuts when they don't impact this labor market?
Well, I think that we're just going to end up having more liquidity circulating. We already see that banks are loosening requirements. They're lowering the requirements for extending credit. We see that credit card balances are being turned over relatively quickly and that charge-off rates are relatively low. We see household bankruptcies are also, the flow of household bankruptcies, relatively low. And when that's the case and we have this cutting cycle, it's just going to support growth. But when we look at the economic fundamentals, when we look at inflation, I expect that we're going to have inflation that's running relatively hot, in part because of tariffs. And we're just going to have this tenuous balance in the labor market because you have this structural shift that's taking place at a time when we have such low immigration. So you have this tenuous balance. It's just going to be sort of a low 4.5% unemployment rate, I think, throughout 2026.
All right, Stuart, great to get some intel from you, and we're going to talk to you later on in the program as well. I will say that kind of a deep tease, right? I'm not so much salivating over Sydney Sweeney.
Can we please stop talking about salivating?
As much as I am over the Swiss National Bank and their inflation problem, which is something that I want to talk to you about. Atkinson and Kehoe, does deflation really mean a slowdown in growth? Let's check on what's going on in futures right now. You can see that we're looking now at losses. Right at the top of the show, we started to see a turnover in some of these big hyperscalers. Microsoft shares
I think it's the Microsoft
down,
story.
NVIDIA shares down on the information report that Microsoft was going to, I guess, reduce its quota on AI software sales.
Yeah, because customers don't want newer products. They say they can't fully realize or at least measure the productivity gains they're getting, and they're pushing back on just how expensive it is. Do we again flip the AI narrative on its head and say, hey, maybe some of the productivity gains, the money that they're going to be bringing in isn't as much?
All right, so that's what's going on in markets right now. A little bit of a turnaround. Let's look at some of the other individual movers on our radar. Stellantis shares in the pre-market were gaining more than 5%, now only 2.5%, after being upgraded by UBS on that report that the White House is going to announce new fuel efficiency standards, lower fuel efficiency standards, so you can buy more of those big gas-guzzling V8s. American Eagle also raised its guidance as the CEO says the summer marketing spree paid off.
Yeah, let's not talk about this one anymore.
Yeah.
And Astera Labs rising as Amazon Web Services' new AI chip is seen as positive for the semiconductor manufacturing company. Coming up on the show, Airbus was forced to revise its aircraft delivery target for the year due to supply and worker shortages and a quality issue. Meanwhile, Boeing is seeing strong momentum. We're going to talk about that next. This is Bloomberg Open Interest.
Let's get now to high interest. Look what's making headlines around the world. The Kremlin says Vladimir Putin held nearly 5 hours of useful talks with U.S. envoys Steve Witkoff and Jared Kushner, but the sides failed to agree on a Ukraine peace plan. Moscow says a future Putin-Trump meeting depends on progress. Meanwhile, Zelensky says real results are urgently needed. The SEC has hit pause on a wave of new ultra-leveraged ETFs, sending warning letters to major issuers like ProShares and Title. Regulators say some proposed products may exceed risk limits and must be revised or withdrawn. It's a rare pause in a boom of complex funds as the SEC questions whether these products accurately capture the volatility they're built to amplify. And Airbus is facing a rough week as it cuts its deliveries target and orders urgent checks on over 600 A320 jets after software and fuselage panel issues surface. The setbacks highlight lingering supply chain stress and contrast with Boeing's recent stock and finance momentum. Dani?
Let's get more on this. Bloomberg Global Aviation reporter Benedict Campbell joins us now. Benny, the issues that we've seen at Airbus over the past week, can you just describe the scale that they are? Because you're seeing this flip where Matt was pointing out Boeing does well, Airbus isn't. Are they on the same sort of scale of woes we saw at Boeing in years prior?
Well, probably not is the short answer. Boeing has really come through a very, very rough patch over a number of years. And what we've seen here at Airbus is a slightly unusual sort of breakout moment for them in the negative sense. So it all started late last week on Friday. They came out with this announcement saying that their software on the A320 aircraft needed upgrading. That happened surprisingly swiftly, I will say. That happened over the weekend. When I saw the first numbers, 6,000 aircraft that needed the upgrade, I think most people thought this would be something that would take them well into sort of the rest of the month, maybe even next year. And by the end of the weekend, it was all done. But then problem number two arose out of nowhere, which was these panels that cover the aircraft. They have some of them that show some discrepancies versus the specs that are required. So what they're doing now is checking them all. And that's a sort of arduous process that will take a while. And that's essentially why you got sort of the hit this morning where they said, we won't be able to make our delivery targets for the year. We're going to be a smidge lower. The original target was for 820 aircraft, and now it's 790. They did keep their financial targets in place, and that might explain why the stock didn't fall off a cliff again. It had a really epic meltdown early in the week, but today it managed to sort of hold its gains.
You know, I always look at the 5-year performance of Airbus versus Boeing, and when you zoom out that far, Airbus is just crushing it in terms of the stock, right? It's well over doubled, and meanwhile, Boeing is in the red. I've also heard you, Benny, talking about the A320 as, I believe, the world's most flown commercial aircraft, right? Are they completely dominant?
That is correct. I mean, dominant is probably too big a word, but they have certainly come from nowhere. I mean, a while back, admittedly, in the late 80s. But, you know, Boeing back then was sort of the only game in town. And the A320 has really sort of taken that position away from Boeing. Obviously, they're still sort of neck and neck, shall we say. Boeing still wins a fair portion of the business. But these days, the A320 and its derivatives, so the 321 and the XLR and all those types of planes, that's really where the action is right now, and it's put Boeing under considerable pressure, and that will explain that chart that you just showed, and a big part of the Airbus story is built around the A320, which would explain again why people are somewhat nervous about anything going wrong with that plane. Airbus does say we've got a handle on this, we have it under control, we'd rather slow things down and take the hit on the deliveries and make sure that everything is safe. But again, this is a plane that people look at very, very closely just because it's such a big money spinner for Airbus.
Yeah, and we also saw just how many airlines had to cancel or delay their flights because of that. Benny, thank you so much. Bloomberg's Benedict Campbell. Coming up, Truist Keith Lerner says this bull market deserves the benefit of the doubt as fundamentals remain strong. He's going to join us next on Bloomberg Open Interest. The S&P 500 is still hovering near an all-time high, but this time around, big tech is not leading the rebound. Concerns around AI valuations are sending traders to other areas of the market, with RBC's Lori Calvasina saying, quote, leadership is ready to rotate. Jitters on the AI trade, the Mag 7, and market concentration have run high in our meetings with institutional investors over the past few months. Joining us now is Truist CIO and Chief Market Strategist Keith Lerner, who also says, Keith, you've written in your most recent note, it is time to take a pause and assess where we are in the cycle. So almost kind of a similar bend to Lori Calvasina. Are we reassessing not just where we are on the overall level, but perhaps leadership for this market?
Yeah, well, first, Dani, always great to be with you and Matt. We just released actually this morning our 2026 outlook called the 7th inning stretch. And to your point, it's a good time to assess where we are. I think the main takeaway, the punchline is we've come a long way. We still think there's upside. And to your point specifically, kind of with this baseball theme, we are still sticking in our view with the power hitters, which is AI and tech. I think it's actually good that we have some questions about it, but we have to remember, you know, that the tech trade off the lows was up 70%. That was almost more than double the S&P as a whole. So I think it makes sense that you're seeing some breathers, a little bit of rotation, but the earnings momentum is still the strongest within tech. Over the last 3 months, the forward 12-month estimates for the technology sector are up about 12%. That's about more than double what the S&P 500 is.
So You think these questions that we have just give investors a buying opportunity because we don't see retail running in and buying every dip, or is there another reason that you think it's good to be questioning this AI bull market?
Well, I think in some ways, Matt, by questioning it, having some of these rotations, it actually helps it from becoming a bubble, and you can kind of, eventually start to reclimb that wall of worry. I mean, I would say back at the end of October, tech got to about a 32 PE. That was the high of this cycle, and now you've come back down again as earnings have moved up. So I just think that, as you have more and more questions of a bubble, it keeps things in check as opposed to this kind of straight up move like we had in the late 90s, where valuations went to a 50 PE and we saw euphoria. We're just not seeing that today, and often euphoria coincides with market tops. Today, it's more divided, which I actually think is ultimately a good sign because, not everyone's in all at once.
Keith, though, narrative shifts are happening thick and fast. Today, it's concern on this information report that Microsoft is going to lower their AI quota because companies don't know how much it's adding to productivity. Just what kind of volatility, quickly here, are we seeing because of the difficulty in understanding the promise of AI?
Yeah, well, I think in some ways, AI, the way the benefit will work is almost like a J curve. Like companies and employees need to understand how to use it effectively first, and then you get the productivity gains. But it doesn't happen overnight, and typically you might even see a little bit of a dip first beforehand. So maybe that's what you're seeing today. But I think, in our view, we're still somewhat in the early adoption phases of AI, and we think that has a decent runway to go.
All right, well, we've definitely seen a turnaround today in terms of futures, and the opening bell is up next. Keith, you're going to stick with us more from Keith Lerner on the other side of this break as we see the S&P 500 futures drop now 14 points or 0.2%. This is Bloomberg. Moments away from the start of trading after a shift in sentiment in the last hour. This is Bloomberg Open Interest. I'm Matt Miller. You can see we are now looking at a down day. S&P futures off. It's only 0.2%, but we were up about that much before 9 o'clock. The Nasdaq down, futures down about 0.4%. The reason is the information reported that Microsoft is going to lower its AI software sales quota as it's harder to prove profitability from that. Here on the New York Stock Exchange, you may recognize Jenny Johnson there from Franklin Templeton. She's ringing the opening bell with her senior vice president of Muni bonds, the FTMU, FTNY. They have a suite of muni bond ETFs. I'm sure Paul Sweeney over in radio is fully invested in. And then you've got a private company ringing the bell on the NASDAQ market site, Deep Energy, together with Daniel Energy Partners. I believe it's a water company out of Texas, and that commodity is getting more and more precious, especially in those sand states.
I'm surprised a private company is ringing the bell.
Maybe they have, they have bond issuance.
Got it.
That I saw on the Bloomberg terminal.
Okay, noted. Anyway,
Yeah.
Matt, I am looking at Macy's this morning because shares are down pretty sharply despite the fact they raised guidance for the rest of the fiscal year, saying that, consumers are still strong despite some of the economic concerns. The issue is if that is so good, then why would your fourth quarter be in line on the high end of the range and missing on the low end of the range if you have really good holiday sales? So that in itself is maybe raising some alarm bells, or ringing alarm bells rather. So shares, they were down 4%, now down just 0.7%, Matt.
All right, so that's a look at retail right now. And then, of course, as Dani mentioned right before the break, Microsoft is down after a report that it is lowering its AI software sales quotas. Corporate customers have complained that it's hard to measure the savings from using AI technology. According to the information, that news sent the broader market lower, with the S&P 500 and the NASDAQ turning negative. You can also see Microsoft shares themselves down about 2.2%. I believe NVIDIA was down in the pre-market. Let's take a look at what NVIDIA is doing in the cash trade. It is also off about 0.8%. Let's bring back in Truist CIO and Chief Market Strategist Keith Lerner. Keith, you were just talking about Dani, with Dani about this, and we don't see huge moves in companies that have come so far so fast, certainly NVIDIA, but there is kind of a shift in leadership even within the Mag 7. What's your take on the TPU versus GPU discussion?
Well, I think, I mean, one, there's just a huge amount of demand in this space still, and there's going to be more competition. You know, NVIDIA's had this big lead, and, you know, other companies like Google are coming in, and, you know, it's still obvious that I think NVIDIA has the lead, but they have these huge gross margins, and it makes sense that, you know, these other companies with big balance sheets are going to try to come after that as a whole. So I mean, I think what you're also seeing as a result of that is you're just seeing, you know, within tech, you're seeing this kind of big dispersion. So it's not monolithic trade anymore. And that's where, you know, fundamental work does help. If you look at the Mag 7 this year, what's interesting, only 2 of the 7 stocks of the Mag 7 are actually outperforming in the S&P, but the ones that are outperforming this year are outperforming by a big margin, which is lifting the overall market. And I think that's what you have to keep in mind. Like, not everything's going to work, but the ones that work, if you can have big gains, it's almost like venture capital that they can often offset some of the losers.
Well, Keith, this feels like a key way that it's different from the dot-com bubble, because back then it was kind of, I guess, straightforward or easy to understand what the internet was, what a website was, maybe the promise going forward. But this time it's different. To Matt's point, it's trying to analyze what TPUs versus a GPU, what AI data centers are being built up and who has leases and who doesn't, and what the technology means and how you get revenue returns on it. It feels deeply, deeply complicated. If you want to have alpha and do better than just beat the overall market, do you all of a sudden need to have a knowledge base that is that of an engineer? How do you gain knowledge and gain edge when it is kind of confusing to the everyday person?
Yeah, no, it's a good point, and that's why we also have on our team, you know, specialists in the technology sector to help us guide us through. You know, a lot of us as strategists, we're more generalists, so we have to rely more on the analysts that are doing kind of, you know, the deep work on that side. But the other thing, if I try to keep it simple too, if I kind of, you know, zoom back from a macro picture, you know, what we focus on, especially with tech at large, is their earning trends. And not just the earning trends on an absolute basis, but more on a relative basis. When we look back, let's say from 2022 to the current, tech underperformed in 2022, and that was a period where the earnings momentum was actually moving lower relative to the overall market. Since that period, over the last 3 years, tech earnings have been moving up at an accelerating rate relative to the overall market. That's gone hand in hand with outperformance. So right now, partly why we're still positive is that earnings momentum is continuing. I mentioned earlier, again, over the last 3 months, we're seeing the forward earning estimates for tech, even with all this uncertainty, up about 12%. The S&P is up around 5%. So what gets us more negative on the sector is if we start to see that earnings momentum really slow down in a meaningful way. Obviously, the news from Microsoft today is not great, but I think we have to be careful that we don't over-extrapolate each headline either. And at this point, in this kind of macro backdrop, which still has a lot of uncertainty, as we saw with the ADP report, I would say it's hard-pressed to find a sector that has stronger fundamentals.
You mentioned the ADP report, and that, you know, brings us to the consumer and to retail. If the labor market is getting weaker, do you worry about those earnings margins? Do you worry about the U.S. consumer? And could those things break before, you know, tech dominance?
Yeah, as a portfolio manager, I'm also a risk manager, and I always have things to worry about. I would say that our base case is this. Our base case is we actually see a modest uptick next year, and that's really premised on 4 main factors. You know, one, there should be some positive tax incentives that is positive for consumers and businesses that hit in the first quarter from the tax bill. We should have moderately lower interest rates, so that's not a game changer, but again, on the margin as well. We also should have, you know, AI spending that continues. And then the other point I would bring up is employment matters as far as the monthly job numbers, but what's probably more important is the 160 million people that are working that they have wage growth above inflation, which is the case today. So we expect that likely continues, and this kind of muddle through continues, but with a little bit of an uptick. And we should have a little bit more clarity even on the tariffs as we move into next year. So again, not a robust environment, but we're looking for actually a slight uptick as we move into next year.
Is that uptick, Keith, enough to lift up consumer sectors? If I look at how the sectors have done year to date, real estate's the worst, but coming in second and third to worst are consumer staples and consumer discretionary. What kind of turn in the economy, or at least not downturn in the economy, do you need to see the more consumer-oriented sectors do well?
Yeah. So it's a great question. And going back to Matt's point, part of the overall market is still being driven by tech. We know that's the biggest allocation, and that's where the margins are really large. So I think for these other areas of the market to actually really pick up, or we actually see this broadening trade, especially given how stretched these areas are to the downside, you do need to see that pickup. At the same time, you need to see the Fed cut rates and inflation to moderate. So you really need that kind of Goldilocks overall environment. In our work, instead of trying to guess that, hey, this is going to happen by the first quarter, we'll be looking for those relative price trends to change and the earnings momentum to shift. It hasn't happened yet. Some of these areas are, as I mentioned, like 2 standard deviation underperformance, so they are stretched. But we're just going to be patient to actually see it show up in our work and hopefully participate in the meat of the move, as opposed to trying to call the exact low of that shift.
Keith, we're seeing a bunch of headlines from Scott Bessent right now speaking about his plan, a plan for Fed governors, Fed presidents, I should say. He wants them to live in their district for 3 years. And we've heard so much talk about, the potential for the Trump administration to throw out all of the regional Fed presidents and install its own suite of yes men and women. Is it too far divorced from the bottoms up analyst of stocks or the top-down look at earnings to worry about the administration taking over the Fed and throwing away independence?
Well, what the Fed does do matters, and we see that because if we think about the previous peak for this market back in October, it happened on the same day Powell pushed back on a rate cut in December. So if we do have a situation, where term premiums start moving up, there's more, the inflation expectations start to move up because of, some uncertainty around the Fed and the organization moving forward. I mean, that is certainly, a risk to the market. So is that enough to offset, earnings? Probably to a certain extent, because what will happen in that environment is, you're likely to see valuations compress or not expand at minimum as well. So as we look into next year, I mean, it's a two-way risk, right? That could be one side of it, or the other side of it is you have more of a, some shifts on the margin where you see some more dovish folks come into the Fed and the market starts to price in lower interest rates, and that actually is a positive. But to your point, Matt, the uncertainty around Fed independence is certainly a risk as we look into next year.
Hey, Keith, thank you so much for joining us. Please come to set next time in New York, also because you owe Matt and me a pickleball game. That's Truist. Keith Lerner, great to get your thoughts and your new outlook as we head into the new year. All right, a check on the stock market. We're actually not doing as bad as we were right at the open. We're down by just 0.1%, maybe what Keith was talking about, more dovish Fed presidents. We don't care about independence. We care about cuts. Apparently, looking at the gainers, Apple and Tesla doing well. Tesla doing well. Robotics companies in general are doing well, with reports that we could be looking at an executive order from the White House on robotics to promote them, and Tesla would be a beneficiary of that. Microsoft, the biggest loser, no surprise, after that information report story we've been talking about, that Microsoft is not, or at least lowering its quota for AI customers because people are pushing back just how productive, just how much money are they saving it from. Shares are down 2.6%. Looking at the sectors this morning, it's no surprise that tech is doing the worst. That is all Microsoft, down 1%. That's enough, despite the fact most of the other sectors are in the green, Matt. That is enough to drag the overall index down, but not by a whole lot at this point, just about 0.1%.
All right, coming up, we're going to talk about cars. Stellantis is seeing its shares gain after an upgrade from UBS as the White House gets ready to ease fuel economy regulations. We'll take a look at how that affects this industry and the consumer next. This is Bloomberg Open Interest.
Let's look at the top calls this morning, the analyst action we're following. First up, Wells Fargo has initiated Oracle at overweight, saying it's become a major AI winner thanks to big customers like OpenAI and a rapidly growing backlog of AI projects. The firm expects Oracle Cloud Infrastructure to triple its market share by 2029 and close the gap, or continue to, with Amazon and Microsoft. Shares were higher in the pre-market, but with that Microsoft information story that has flipped, they're now slightly weaker. Next up, Arete says that autonomous vehicles will ultimately help major ride-hailing platforms rather than threaten them. The firm upgrades both Uber and Lyft on the view that AV makers can't produce affordable self-driving cars at scale, keeping AV networks uncompetitive. The firm sees Uber as the clear leader thanks to its higher income riders and Uber One momentum. Finally, UBS, they've upgraded Stellantis to a buy. They're arguing that the automaker is positioned for a North America turnaround next year. They say it's driven by recovering market share, a better product mix under looser U.S. emission rules, and ongoing cost cuts. Matt?
Dani, stop trying to make AV a thing.
I know, I had a really hard time not saying EV.
Yeah, I don't think, that's not the kind of phrase you can just throw around.
But autonomous vehicles is like a mouthful. So if I could theoretically say AVs without tripping over it, it would be better, but apparently I can't.
All right, let's focus in on that story and really on the CAFE standard story. I'm most interested in that. Let's go out to Detroit right now and talk to the bureau chief there, David Welch, because, David, it's not just Stellantis that would benefit from looser regulations as far as emissions are concerned. Ford and GM, I believe, already are reaping the rewards of this policy or lack thereof. I've read stories from you and Keith Naughton on how much money they're saving. What do we know that's really going to happen in terms of lower emissions regulations?
The Trump administration hasn't put out specifics, but what they've talked about are wiping away the fines for anyone who misses their clean air and fuel economy targets. and what that would effectively do is, and by the way, they would also reduce the standards you have to meet. So somebody like Stellantis, they're uniquely impacted by these standards because they don't really sell many small vehicles that can offset their gas guzzlers. They don't sell a lot of EVs and hybrids that would generate credits for them. They were really in the worst position on this. But really, all of the companies, their stocks were under, let's call it the pressure of what one analyst at Morgan Stanley called the melting ice cube, ice for internal combustion engine. The thesis was that those businesses were just going to slowly melt away, and electric vehicle makers were going to be the ascendant purveyors of transportation. They were going to take all the market share. And as the companies like GM, Ford, and Stellantis moved into electric vehicles, they would lose money on those, but their cash cows, SUVs and pickup trucks, would be melting away. Now, not only do we see that people aren't buying EVs that fast and that the Trump administration has taken away the incentives to do so, but the penalty for selling gas guzzlers is also, at a minimum, going to be really reduced. So these companies can continue to print cash with pickup trucks, large SUVs, luxury cars, all that stuff for the foreseeable future, as long as the Trump administration's policies stay in place. That's lifted all kinds of pressure off the stocks. That's why GM is trading above 70. That's why Stellantis is up today. And so it's really changed how investors look at the sector.
So no one expects prices to be cut for, a new Hemi or Godzilla or GM's 6.2-liter V8 stalwart, but maybe they won't raise prices as much over time if they don't have to pay these penalties. And maybe we have more big V8 options. Is that going to be the result?
Yeah, I think so, because the automakers aren't going to basically start removing fuel-efficient or clean air hardware from their vehicles. Because if a Democrat comes in office in 2028, you're going to see rules tighten up again. What they'll do is they'll just pull back production on electric vehicles, and they'll let loose production on their thirstiest and most profitable vehicles because they're not worried about having to cap those sales because of paying any kind of penalties. And that is one thing that the Trump administration has talked about, is just wiping away any penalties that you have. In the case of General Motors, look, they've said that the Chevy Bolt, their smallest EV, they're only going to make that for a year, and then they're going to look at a next generation Bolt at some point. Part of the business case for that was generating electric vehicle credits to offset the pickup trucks and SUVs that they sell. They now feel they don't need to do that based on their read in Washington, and I think you're going to see that across the industry, where anyone discounting their EVs just to generate credits, they're not going to be doing that.
It still does have the feeling of a White House that is squarely focused on affordability, whether or not it has that impact or not. David, thank you so much for joining us. That's Bloomberg's David Welch in Detroit. Coming up, shares of Eric Trump's American Bitcoin get rocked in a 26-minute plunge yesterday. That adds to the pain for the Trump family's crypto ventures. Details coming up next. This is Bloomberg Open Interest.
This is Bloomberg Open Interest. Quick check on what's going on in stocks. We do see now red arrows after futures were higher until about 9 o'clock when an information story came out and said that Microsoft was going to reduce its AI software sales quotas because companies have been complaining that it's difficult to measure profitability and productivity from those products. As a result, you see these Mag 7 stocks down. I mean, NVIDIA had already turned down, and Microsoft is now down about 3%. We had sales, actually earnings that beat at Macy's and an outlook that was lifted, but investors expected more, and the stock is down 2%. Meanwhile, at Dollar Tree, you see the gains only 0.7%, but the consumer is increasingly shifting down to those kind of discounts. Bitcoin right now up more than 1%, so back to over 90,000 at 92 and 3/4. And then ABC, can I call it that? American Bitcoin Corporation right now. A big rebound, Dani, of 14%, but that's after a huge plunge.
For what it's worth, I think you would say ABTC. That's its ticker, if we're just splitting hairs. Let's talk about that huge plunge, though. It has Eric Trump, of course, among its top leadership. So yesterday, we saw it plunge 20%, 30%, and then 50% in just a matter of minutes yesterday. All of that adds to the woes of the Trump family's crypto project. Bloomberg's Emily Nicole is here to explain. Emily, I was going to say, I feel like I saw a mat in the corner of my eye. Emily, what went wrong? Why did this thing plunge so much yesterday?
Well, it turns out that yesterday's stock was more of a reason because of the product itself. So for American Bitcoin, it was a company that is born out of a merger that happened with another crypto miner called Griffin Digital Mining earlier this year. So when that happened, there was obviously some stock that came with it that was locked up. Supposedly yesterday was the first day that was all released available for trading, and that is what the company says anyway caused the massive downturn.
So this drop, and to be clear, we're seeing a rebound today, and it's also still higher than it was at the start of the year, but it's become a symbol of the crypto market wipeout and also the Trump family problems with this massive empire that they've built on the coattails of, Eric Trump's father now is in the White House. How much money has the Trump family made on these developments?
I mean, I can't tell you off the top of my head. I know we were reporting somewhere between 500 million to $1 billion earlier this year. It's definitely changed over the course of that. It also kind of depends on what you would consider, made, because some of this is just paper wealth, right? Like if we think about the tokens, for example, that the Trump family have launched this year, we have Liberty Finance with their token. We have 2 meme coins from Trump and Melania themselves. Both of those are kind of very much struggling now with the broader crypto market, while Liberty Finance is down about 50% from its peak when it launched in September, whereas the meme coins are down well over 90% from their peaks back at the time of Trump's inauguration. And so, if we think about whether or not they'd be able to sell any of these things, that kind of dictates how much they might have made. But in general, it probably isn't looking too good right now compared to what they might have had when crypto was up.
Right. Of course, the idea, though, is that you put these tokens out there with a huge stake, and then when they reach their peak, you sell quickly while everyone else gets on board, right? And then you've made the money, and the losses are for the suckers. Emily, thanks so much for joining us. Emily Nicole covers crypto for us out of London. Coming up in the next hour, Sarah Hunt is positive about the stock market going into 2026, but warns of the kind of volatility that we happen to be seeing this morning. So she's the perfect guest. Plus, Motorola Solutions CEO Greg Brown talks about his deal-making spree, the empire that he has built, the massive run-up in the stock, although it has underperformed in recent months. And Ford Philanthropy President Mary Culler joins us to talk about a $100 million milestone. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Dani Berger. We're off the lows, but still negative after that Microsoft headline coming from the information about lowering an AI quota, Matt.
All right, we have breaking economic data crossing the terminal right now. We've got the ISM Services Index coming out a little bit better than expected and a little bit better than the prior reading. And this is more good news. Prices paid was a little bit lower than expected and far lower than the previous reading. Let's break down that data with Bloomberg economist Stuart Paul. He joins us again here on set. So what does this services information tell us?
Look, I actually think that the details of the report are a little bit weaker than the headline figures suggest. Yet there was an uptick in the headline, but part of that was supported by merely slowing the pace at which a decline in employment took place.
Slowing is a word you just made up. And I love it. I love it.
A slowing of the pace at which layoffs are taking place. So we did see within the ADP numbers this week that there are, just this morning, that there are layoffs that are taking place. We still see soft employment figures in here, and we also see relatively weak new orders data in the ISM numbers. And this is services as opposed to manufacturing. Services, you would expect to see some rotation towards services when you have snarled supply chains on the good side. You would expect people to allocate more of their budget towards services. It just doesn't appear to be the case coming through November. So.
Oh, wait. Pot calling kettle black. You did say sidnovating today, which
sidnovating and slowing are two.
Slowing makes way more sense, let me just say.
Yeah.
Stuart, so on top of this, okay, you also had ADP data that's all looking weaker, or at least for small businesses. Does any of this matter when we get headlines like this from Scott Bessent saying that he wants to change the rules for regional Fed presidents to make sure that they live in their district for at least 3 years? It would seem to be laying the groundwork to completely reshape the Fed and probably get it more dovish. So do we care about the data when things like that are happening?
I think that a reshuffling of any sort of personnel at the Fed is more important than any sort of survey data that we're getting from ISM or even the ADP data that we're getting this morning. I will say, though, that whether regional Fed bank presidents live in their districts, I think that's basically an insignificant development. When we look at the Board of Governors of the Federal Reserve, there's not supposed to be any overlap in where those governors come from. They're all supposed to come from different districts. And the amount of gamesmanship that takes place when it comes to those personnel decisions is literally like, sure, you're a professor from USC on the other side of in Southern California, but you took a Delta flight that had a layover in Atlanta, so let's say you came from that district. I imagine that we're going to have basically the same thing. Okay, so you went to grad school 2 decades ago in Texas, and so we'll say you came from Dallas. The amount of gamesmanship that we can see around that sort of development is a little bit wonky. So.
But by the way, it would feel like a good thing to actually come from the district you represent. Right?
Well, it's really about the relationships that you have with the private sector, right? It's with the bankers, the Class A directors, with business leaders, and with the Class B directors, and with the rest of the community, your Class C directors. And so if you're able to maintain relationships with those people, I don't think that it matters that much whether you're actually from the district. And in an age where communication is a heck of a lot easier, and in districts that are so large, it's not like you're seeing all these people in person anyway. I don't think that it's that huge.
I mean, this is something that we talked about on this program with Stephen Meyer. Remember, I was like,
true.
Does it matter that the heart of the Fed is really in this Harvard, New York, pipeline? And he's like, I went to Harvard and I'm from New York. They all did, right? But the point isn't where they're from. The point is that this could lay the groundwork for dismissing all of the regional Fed presidents and installing people who agree with President Trump along, ideological, political, and rates lines.
That's right. It's not so much the technical changes that he's proposing as it is a transformation of the institution that matters. And any sort of tinkering sort of suggests that there's an acceptance within the administration that an effort towards politically capturing the Fed as an institution is just an idea that's taking deeper root within the administration. Secretary Bessent was seen basically as the voice of reason when it came to preserving an independent Fed. As much as he advocates for having lower rates, he is the person who is seen as supporting that sort of institutional independence. And when he talks about interfering to any extent with how the institution operates or altering the Federal Reserve Act in any way, I think that's more important than the specifics of his proposals.
Hey, Stuart, thank you so much for joining us. That is Stuart Paul of Bloomberg Economics. And for anyone just joining us, ISM Services hits 9-month high, prices paid to a 7-month low. S&P 500 turns around off the back of that data. Joining us now is Sarah Hunt, Alpine, Saxon Woods, Chief Market Strategist. Sarah, so it's this time of year where we're all trying to put together what we think is going to happen in 2026. Just even that conversation with Stuart about potential changes at the Fed, we're talking about who's going to be the chair, will it be Kevin Hassett? How difficult is it to even put together a forecast when you could have very fundamental changes at the body that dictates so much of where this market goes?
Well, since I'm trying to do mine right now, I'm going to say it's very difficult.
Yes.
I think that there is a lot that we don't know about next year, and we're coming into next year on a relatively highly valued stock market with a lot of promises. And I think just the fact that this morning's story on Microsoft had the NASDAQ wobbling a little bit tells you that the big story on AI is the one that people are going to focus on. So you have these two different aspects that are going on. You've got monetary policy, which is important to the market as a whole. You have AI, which is important to the market as a whole. And those two things seem to shift what narrative is most important depending on what's happening on a day-to-day basis.
By the way, does the cockroach conversation concern you at all? I mean, the idea that private credit, which is blowing up, and we should make the distinction between the leveraged loan market and
I was going to say some of the blowups have also been public credit too, just, you know,
for sure,
some of
and
them.
In broadly syndicated loans.
Correct.
We all read Mark Rowan's op-ed piece this morning, so we're well versed in this. But the concern is that in a rush to put investor money to work, maybe in some places, not Apollo, lending standards may have been loosened, and we're not seeing the marks that we should. Does that concern you?
I think that's always a concern because you don't have the kind of liquidity and you don't have the kind of transparency that you have in some of the public markets and some of the private markets. But you can say that about private equity. You can say that about a lot of different things. And I think it really depends on what is happening under the surface. If rates are going higher, that's more of a problem than if rates may be going lower. If rates are staying the same, it's really when do you see those problems and when do you see those cracks? And we've obviously had a few come out in the last year or so. I anticipate that there's always going to be a few more because there are people rushing to do things. And for private equity with the IPO market that isn't as open as it has been in prior years, there's a lot of ways to try to extend some of those things, and whether or not that works is going to be another issue that people are going to start to, I think, worry about if you start to see blowups, because there were a couple last week. So,
by the way, I was just saying, Scott Besson also speaking at the New York Times event saying private credit growth is a sign bank regulation is too tight. So Jamie Dimon would be happy about that. But Sarah, everything you're describing, okay, so you have all this money sloshing around. It's going to different corners of credit, but also even within this equity market, you have people playing on various insanely leveraged crypto plays, very, very unprofitable companies that have been so volatile. Is there not a feeling, you know, I don't want to talk about what inning we're in because everybody has some different sort of analogy they want to use specifically.
Yesterday, Nancy Tengler said third inning.
Yes, and Keith
and today Keith Lerner said seventh inning.
None of it matters because because baseball is long and it's very confusing. But doesn't that all have this feeling of like we're reaching a point of unsustainability if we're talking about credit flowing to all these corners, to unprofitable companies doing well? Like something about it, I think, maybe feels a little bit nervy.
It does feel a little bit nervy. I mean, I would have said the same thing in 2015, though. I mean, then that's the problem, is that it feels a little bit nervy, but we've got to that point of so much money sloshing around. It's not being withdrawn yet to an extent that becomes an even bigger problem. Do we see excesses? Absolutely. Do you see some things that don't make a lot of sense on a longer term basis? Absolutely. But there's a lot of money chasing things, and right now that's still the case. And you can worry about it, which we do, but you also have to look and say, okay, what is the catalyst that's going to bring that to the fore? And if earnings were coming down, I'd be much more concerned than I am if earnings are potentially going up next year. And I think that's the reason why we're cautiously optimistic, even though we see a lot of volatility.
You know, coming into this year, or certainly on April 2nd, you would have thought everything was going down, right? Because of the massive tariffs that seem to have very little thought behind them and the huge, boards that we saw on the White House lawn. Now everybody is so bulled up. And Howard Lutnick right now on CNBC is saying he expects GDP of over 4% in 2026. What's the risk we're getting next year wrong as well?
Well, I think that there's definitely a risk we're getting next year wrong. And if you're going to be cautious, that's one of the reasons that we tend to focus on both dividend-paying stocks, cash-generating stocks, and companies that can buy back their own stock and do some of those things, because if you get some of those tariff issues that we've sort of pushed all the way through this year, and some of those are not really a problem yet from an inventory standpoint, into next year, that earnings growth that everyone's counting on could be slower, or it could be in places, it could not be as strong in places as people expect. Right now, it looks like technology is going to be very strong again next year. If you start to worry about that pace of that spending, and you start thinking that things are going to be a little bit slower, I think that's where you get much more of the concerns to come through. And that's where the fact that you're looking for companies that have a stronger basis in a fundamental valuation are someplace where you feel a little bit more comfortable.
Well, this all comes back around to the Microsoft story from the information this morning. We were talking to Keith Lerner about this. It's this feeling that narrative shifts are happening really quickly because the technology is so complicated. It's not exactly clear just how productive or how companies are going to use it. What does that mean for trying to pick the winners within tech, or even with just trying to trade it or understand where it goes from here, because everyone all of a sudden needs to have like deep information about what a TPU versus a GPU is?
And I think that it's not a huge surprise that people are having a hard time trying to put numbers around these, because are people actually being productive? Are they sitting there making GIFs? Are they doing, like, what are they doing with the AI, as opposed to, I can understand it, I can track it, I have a metric. This is a, relatively speaking, it's not completely brand new, but the way we're using it is new. It is not surprising to me that people are trying to figure out whether or not it's worth the money, while they're also worried about their margins, right? Because that's the whole, that leads into earnings too. I want to be making sure that the money that I spend I'm getting some value for that money. I think that you're going to continue to see problems or questions like that, and new use cases come up. And how those things interact is going to be a great driver. And to your point, it's difficult to pick which company is right in the forefront of it, because if other people are now chasing NVIDIA's tail, or there's another way to do this, then there isn't only one company that is really going to benefit from all this.
By the way, for me, AI has been most useful in terms of cooking dinner, and it's really improved my game there.
Yeah, but did you not see that Bloomberg news story that
I saw that story. I saw that story.
If the AI summaries of the recipes are bad,
right,
and if you follow it, you would make like a cake made with like baking soda instead of sugar and salt.
I'll tell you what, it has not failed me, and I cook dinner every night. And also for sort of differentiating between different generations of air-cooled 911s. But what, Sarah, do you use AI for? I mean, has it improved your productivity at all at work?
So we're using it and definitely looking at ways that you can ask it questions about a company. What do you think the most important things are? It does a whole lot of work for you, and then you go through them and go, is that really true or is that not true? Because I think we're still proving out a lot of the information that it's coming from isn't necessarily the best information. So the problem with it, and to the extent that people are questioning the productivity, is if you just put something together and hand it off to somebody, you haven't checked through it. There's a lot of information that may be in there that you don't necessarily, that is not necessarily right, and or you don't want to look at it, and you don't want to give it to somebody without going through it. Yeah. And I think that that's one of those things where the original, I can get a whole bunch of information originally, I still have to go through it, but it's gathered a lot of stuff that would have taken me hours to find earlier.
Yeah, same as the old Twitter problem of commenting on an article before you've read it or posting it without having any idea what it says. Sarah Hunt of Alpine, Saxon Woods, great to have you on set this morning. Coming up, freed by President Trump, a $200 million fraudster, then started a new scam. And now he's said to be planning to ask for clemency again. We'll discuss today's amazing big take. Next, this is Bloomberg Open Interest. Let's take a look at today's big take. It focuses on Ellie Weinstein, who stole millions of dollars from investors during COVID after President Trump commuted his sentence for an earlier conviction for stealing millions of dollars from investors. Bloomberg senior reporter Silas Brown co-wrote this story, and he joins us now. It is an epic read. I could not put it down, Silas. Congratulations on this reporting. What do we know now about Weinstein and what he's done, even after he got a commutation, a pardon from President Trump?
Well, I congratulate you on being able to read such a long story, firstly. But I think it's. I mean, there's a lot here, and I think the thing I like about the story is there's a circularity to it. You know, he was a twice convicted fraudster. His sentence was commuted by Trump, only to sort of embark on this kind of like fresh Ponzi scheme. yeah, I mean, we basically follow the story as it unravels, and kind of as he's now approaching, he's been sentenced and he's appealing, and he's also been reaching out to advisors to try to drum up interest for a second commutation.
Silas, as a longtime reader of every piece of reporting you put out, I'm not surprised that you put out such a fantastic piece. But look, it's this kind of question of like, how does this happen? How do communities that are like built on this idea of trust become so vulnerable? And then I guess on the flip side, finally wake up to what's actually happening?
Well, I think what's interesting about Ponzi schemes is that they all seem very dissimilar to each other. They all have different characteristics. Often they're kind of targeting different types of investors. But actually, you can see similarities on a kind of more conceptual level. I mean, in this instance, there's two sets of investors who have been victims in this most recent Ponzi scheme. One set, which is a kind of from a religious sort of fringe movement, a kind of fringe Christian movement, and then another a set of entrepreneurs that all found each other through this kind of entrepreneurial network. And these two kind of very ostensibly different sets of investors are kind of bound into the same kind of tragic story. I may be naive, but I was surprised that there's so many crooked people out there using fake names for their Ponzi schemes, and they all seem to be from sort of extremist religious groups, either the fringe Christian or the Orthodox Jewish pack working together. Have you thought about making this into a movie? Because it truly is that dramatic. Well, I must say, Bloomberg has done a very, very good documentary that's 20 minutes long. I think maybe we could stretch it to a longer one. Because I mean, there's a lot of parts of the story that we simply weren't capable of slotting into either the documentary or the long form print story. I mean, there's a lot of twists and turns. It's kind of extraordinary story, actually. It's certainly the most kind of chaotic piece that I've worked on.
I also wonder, Silas, who falls victim to these sort of get-rich-quick kind of Ponzi schemes? The woman at the top who went on the cruise with Anderson, why wasn't she investing with normal, banks or brokerages? How could they find this many victims?
Yeah, I mean, if she was watching Bloomberg TV, maybe she would have. No, I think generally, I mean, I think everyone's susceptible to these sort of things. And what you said about the religious movements, I think, is very important. I mean, not that it's the religious movements themselves. It's just that the co-conspirators, at least one member of the co-conspirators were part of these networks. And I think once a co-conspirator, once a fraudster is within a kind of tightly knit group, as religious movements are, but other movements are as well, I think that adds a layer of trust that I think supersedes some due diligence. And I think that's significant in a lot of Ponzi schemes.
Silas, 26 minutes is enough. Matt and I are looking forward to your 1 hour and 26 minute plus movie on this. Silas, thank you so much for bringing that reporting. Silas Braun, everyone can go read that excellent story. NI Big Take is where you can find that on your terminal. Coming up, Microsoft bet big on AI agents. The information now saying it's reportedly cutting sales targets. We have the details for you. Coming up after this break, you're watching Bloomberg Open Interest. Microsoft is reportedly dialing back expectations for AI tools as corporate customers resist paying more for agents that struggle with completing tasks. Joining us now to talk about the implications for the AI trade is Bloomberg's macro strategist, Michael Ball. And Michael, this feels significant, one, because it seems to be bringing the overall market with it, but just how fast these narratives are changing. We've gone from, productivity is going to be so much better, to examples. And Carlyle is an example in the story, basically saying that they were using Copilot and then went to Microsoft and were complaining to be like, hey, we couldn't pull the necessary data that we needed. Should we just be used to this narrative whiplash now we're getting?
Yeah, I think the adoption's going to be volatile. And I think every company is going to have its own experiences. And the problem is we're going to get flooded with these individual narratives, and it's going to weigh on the tape, and it's going to hit certain names more than others. And then overall, the question is how long to profitability and productivity.
The volatility, I mean, isn't in the whole market, right? It's just concentrated on these few names that move it. It doesn't seem that severe, right? You talk about a battleground levels between, what, 6750 and 6800. That's like a very small trading band.
Yeah, we're right now in an area where we've had a lot of pinning from positioning in the option market, and also everyone's just waiting for the FOMC next week. So overall, the volatility is finally kind of condensing. So realized vol has come back in, which is allowing more participation in the market. But to your point, every day is a new mega cap story that kind of then rotates capital maybe out of one name into other names as winners and losers are picked.
Does the FOMC meeting matter that much? I mean, there's a 95% chance of a rate cut, and no matter what, you know that this administration is going to put in an extremely dovish panel of voters in 2026. So rates are going down, whether it's December or 26.
I think it's the combo of the meeting and then the data we're getting right after it. So you do see a kink in the vol curve and the surface. But to your point, you're right. I think everyone's kind of accept that we're going to get this hawkish cut, and then we're going to get leadership change next year. So what does it really matter for projections of 2026, to your point? And you know, that's what the big question is right now.
Michael Ball writes for our MLive blog. You can check that out on the Bloomberg terminal. Type MLIV go. Coming up, North Coast Research gives an upgrade to Motorola shares, says they're a buy, calling the recent sell-off an overreaction. We'll speak to the CEO, Greg Brown, who has built Motorola into a communications behemoth. This is Bloomberg. When you hear Motorola, you might still think of the StarTAC or Razr flip phones, but the company started out almost a century ago making radios for cars and cops and has now built an empire around that technology, selling license plate readers, AI-enabled body cams, command center software to the growing police and defense sectors. CEO Greg Brown joins us on set to talk about building this behemoth that he's run for the last 14 years, during which time the stock has returned all in more than 1,000%. Greg, great to have you here. Thanks very much for joining us. Let's talk about how you, I don't want to say cobbled together because that sounds too weak and small, and what you've done through a string of acquisitions is built really a powerhouse of a communications company. How had you planned that, and how have you executed that over the last decade?
I always felt, I joined Motorola in 2003, and even before I became CEO, I always felt the jewel of the franchise was public safety, mission critical communications. So when I got the baton to run the corporation, we split the assets. We doubled down on all things mission critical communications for public safety, strong revenue growth, predictability of earnings, durable and enduring cash flow, and then we built everything, Matt, around public safety into emergency workflow. So now we do everything from initial 911 call handling to the tough stuff and CAD center, nerve center dispatch to evidentiary management, and we've built the largest portfolio for public safety, and with Silvus now around national security, and that's what we've done. By the way, it's been organic investment and inorganic along the way, still doing double-digit dividend increases every year. This will be our third year where we anticipate double-digit operating cash flow growth. We bought back about $16.5 billion of stock at an aggregate price of 73 and change. So at the end of the day, my job building this company is people and capital allocation, whether it's organic or inorganic.
And Matt pointed out just the incredible run that shares have been on from it. Recently, though, year to date, you are lower by some 17.5%. I wonder how much of this is still this concern about supply chains, because I know there was issues during COVID, and then you add tariffs to it. How much of that is still a headache for you, and how much of it has been cleared up?
I think it's cleared up. I think the deterioration of the stock to date is more about all things in the gold rush around AI. We're not sexy or flashy, but, you know, double-digit order growth Q2, Q3, we anticipate that for Q4. We see a path to $15 billion of backlog, which is our largest. Dani, I think it is investor money going to not just the Mag 7, but all things around AI, data, compute, power generation. And while we're not as sexy, by the way, the fundamentals of the business are really strong. I feel better going into 26 than I did a year ago. So when I look at funding and backlog and product refresh, double-digit orders growth for multiple quarters, video and command center that you referenced, and now with the addition of Silvus, I think the setup is quite good. I think this is a temporary dislocation. By the way, in the meantime, we bought back over 400 million of shares quarter to date, over $1 billion year to date, because the market will dictate our capital allocation, and we've been good opportunistically, and now's, I think, a good time.
One of the things that is sexy is sort of the AI kind of software shift that you've made because of those margins, right? Sure. And I wonder when we're going to see that start coming through in the earnings, higher margins, when we're going to start to see that come through in the multiples. Is the stock market going to reward you for that?
I think you already are, because in addition to the revenue growth and the cash flow growth, we've had consistent operating margin expansion. AI is a beautiful thing. Maybe we don't tout it enough, but we have the most comprehensive use of AI into public safety. We have our latest product, which takes a body camera and a remote speaker mic for a radio, combines it into one, and it's a multi-source AI assistant. It ingests mobile video, it ingests fixed video, it ingests real-time CAD information with a 911 dispatcher, and it ingests real-time emergency call logs for the radio. So it's ingesting all this information, making the dispatcher more productive, giving the first responder tools that he or she needs, and for every 60 seconds of 911 response to a call, it saves 10,000 lives. So you'll see, stay tuned on that front. You'll see us introduce some more things in January we're pretty excited about.
Well, I know you had also talked about one of the lifts to your business had been increased funding by the federal government for things like border patrolling and the different immigration things we have going on. There is, though, a real public backlash in some areas to that. Protests in LA this year, concerns in New York. When you do have a border police, wearing the thing that says Motorola on it, how do you ensure that you as a company don't also get caught up in some of the political backlash that we've seen?
Well, I trust our customers. And, ICE is a part of Department of Homeland Security. Dani, we virtually sell to all of the agencies in Homeland Security. They're a key customer. So we're comfortable that they're using it for the provisioning of public safety, the protection of communities, and they're using the equipment to make them more productive and make our communities more safe with their discretion.
You have a very serious first world problem in that you've gotten investors used to double the gains that they'll get on the S&P, right, over the last 10.5 years. Can you continue on that kind of trajectory for the next 10.5 years?
Well, here's what I would say. We have to be outperforming the market. So it's nice that the stock goes from A to B, but that's irrelevant to me and the management team. Are you outperforming your peer group? Are you outperforming the market? Because people are mobile and capital is mobile. People don't have to invest in Motorola Solutions. We want to continue to make it a destination investment. Our track record around capital allocation, and as you pointed out, over 1,000% total shareholder return since the creation of MSI would warrant a good record. We also know, and I know, we're only as good as our latest quarter and are only as good as our latest year. I feel pretty comfortable on what we could continue to go and do in 26 and beyond.
Greg, you have some really fascinating and impressive technology. I mean, what you were describing with first responders is incredible. The use of different technology put together, but also things like facial recognition, using different car surveillance techniques. Some of it, though, kind of borders on a little bit dystopian, if I'm being honest. This idea that, like, maybe we lose privacy as technology gets better.
Public surveillance.
Yeah, what is your view on just, like, the logical end of this? Where we actually go and how you kind of find that line of aiding this incredible public service you're doing without sort of taking away privacy from people?
So we have something internally called MTAC, Motorola Technical Advisory Council. Everything we do, every product we introduce. I'll give you an example. A lot of our products have AI. You talked about it. We're the only vendor to date to produce AI labels. So on our product, you know what AI model is being used, how it's being used, what it's being used for. We led the industry in that introduction. We have a cross-functional team that's very astute around not being Big Brother, not violating privacy, trusting our customers. The other thing, you referenced license plate recognition. We're one of the leaders in that. Well, it's a very important difference between what you mentioned and how we use it. We use license plate recognition in public safety for our customers. The data is owned by the customer. The access to it is owned by the customer. The redaction and the evidentiary duration is determined by the customer. There are other providers where they own the license plate recognition data. They control it. They can monetize it and sell use to it to other people. In public safety, we don't do it. We take it very seriously, and we're proud of our record.
First of all, that makes me feel better. This has been so interesting. Greg, thank you so much for joining. You have to come back. So much more we could talk about.
Anytime.
That's Greg Brown of Motorola Solutions. All right, a check on your markets this morning. I do want to mention things are turning around. Microsoft is off the lows because CNBC, citing an email from Microsoft executives saying that they have not lowered their sales quota for salespeople. Again, there was a story from the information that they had because there was some confusion on just how productive it was. Microsoft pushing back against that story this morning. NASDAQ, though, is still off about 0.1%, Matt.
All right, let's get a look at some of the other single stocks that we're following. Dollar Tree raised its outlook and expects to see more spending from stretched shoppers. American Eagle also boosted its forecast, saying the summer marketing spree. Was that the Sydney Sweeney campaign?
Yeah. Yes, correct.
That worked. That worked.
Was that a sarcastic question I'm now realizing? Yeah, okay. And Marvell assuring investors that its custom chip design unit is winning repeat orders. It also announced the acquisition of Celestial AI.
Coming up, the philanthropic arm of the Ford Motor Company surpasses a major milestone. We speak to the president of Ford Philanthropy, Mary Culler, next. This is Bloomberg Open Interest. The philanthropic arm of the Ford Motor Company is the first to have donated more than $100 million in partnership with global giving. Here to discuss that milestone and the role of large companies in charity is Mary Culler. She is the president of Ford Philanthropy, and it's great to have you, Mary, on, well, I guess Giving Tuesday was yesterday, but we should always be thinking about what we can do to help out in global crises. Tell us, first of all, about global giving. You've been in partnership with them for many years, and how you work together.
Well, good morning, and nice to see you, Matt and Dani. This is a historic milestone, and what's really exciting is Global Giving has been a partner of ours for years. They really serve as the bridge for connecting with nonprofits all across the world. And so when we think about this milestone, it's not only about the money, but it's the multiplier effect that a company like Ford Motor Company can bring with our employees, with the expertise we bring, with our vehicles, and of course we have this incredible dealer network all across the globe that all get involved in support of these nonprofits.
Mary, the good news is the contributions you're making to societies. The bad news is how many different things it feels like there are out there that need this kind of funding, be it rising inequality, be it issues of climate change. And by the way, all those things happening in very many different places in the world. It can be enough to kind of feel paralyzing. So how do you at Ford Philanthropy, how at Ford decide exactly where that money goes and what projects to take on?
Well, I think that's a great question because there is so much need. And so what we try to do at Ford Philanthropy is really bring our superpower to the table. And so we have really focused on things like disaster relief, community building, because what we've learned is in partnerships with nonprofits, we not only bring the philanthropic dollars, but we can bring things like our vehicles. So imagine during a hurricane or during some kind of disaster, there is a need for nonprofits to have sort of an increase of vehicles to get out and do the work they do. So we have a loaner program through our dealers for that. We have our people. We've extended our volunteer policy so that people can deploy when there's a disaster and go and actually, get in there and help. And then the dealer network, as I said, what I've been incredibly impressed by is that because we are more focused in these areas together as a company, we've been able to network together incredible impact. So for example, we have dealers who are doing blood drives. We have dealers who are doing food drives, all all in sort of support of this combined effort. And just recently, dealers across the world actually did a food drive, and there was a donation of 2 million pounds of food. We've done blood drives where the American Red Cross has said this is so incredible because you're getting new blood donors. So I think a company, if we can find our sweet spot like we have in these areas, can bring the full power of what we can do to help.
Yeah, I mean, Ford has something like 170,000 employees, right? But if you include the massive dealership network and the supplier network, it's going to, I imagine, grow to millions. You're also very global, right? I know that you have production facilities, for example, in Valencia, where you've been able to help out with the horrible flooding that they had. You've been able to help out in Turkey, where they had awful earthquakes. These global crises, do you feel a responsibility to respond not just to what's going on in the U.S., but around the world?
Absolutely. And I think what's really great is because we have this focused effort around disaster relief, we have a turnkey, kind of moment where we already have our nonprofits established. We have the dealers sort of ready to go. We have our employees ready to volunteer. And so recently, for example, during the Texas flooding, within 24 hours, the dealers were already activated. We had vehicles on the ground helping our nonprofits. We had our volunteers deployed, and we were doing everything we could to help in that situation. And I think that's the power of a company like Ford. When our back's against the wall, there's no better company to kind of rise to the occasion. We've seen that throughout history. And our commitment to community is so great that if we can find that sort of sweet spot where we can bring the entire power of our company to bear, I think we just have a much better opportunity to make a difference.
The aim of the more libertarian administrations in this country is to pull back on what the government pays for, because then the private charity will step in. And I wonder if you feel more pressure on that front lately as you cross this milestone.
Well, we've certainly gotten a lot more requests. And, at the end of the day, there's not enough money to sustain all the need, as Dani said. And so what we really try to do at Ford Philanthropy is not only to bring whatever monetary resources we can bring, but I think we have these incredible employees, these incredible volunteers, and they bring their expertise. I mean, for example, recently, food has been a real issue. And one of our employees was actually volunteering at a food bank, and she was with our supply chain group. And she got there and she realized that the way they had set up the entire supply chain for that food distribution was not as efficient as it needed to be. And so she kind of took it on as her own personal project to help them. And so they're much more efficient. They're getting much more food out every day. And so I think that's really the exciting thing, is that, I'm proud of our employees who always look for opportunities to give back, and I think in a really meaningful way.
Can I just quickly ask also how closely you work with Bill Ford and the Ford family? Because I know he has been a proponent of the environment for many, many decades now, and has tried to do what he can through, obviously, the Ford Motor Company assets that he owns.
Oh my gosh, there's no bigger champion than Bill Ford on the community front. He really is our North Star. He established our volunteer program 20 years ago. He's always looking around corners. He's always thinking ahead. He's always looking for innovation. So he always challenges me personally to look for innovation in philanthropy. And so I couldn't be more proud to be a part of a company that has a family like the Fords behind it.
Hey, Mary, so great to hear about the wonderful work you're doing at Ford Philanthropy. That's Mary Culler of Ford Philanthropy. Coming up, Cadillac's F1 team planning to reveal its new F1 car during the Super Bowl. We're going to get the details next of the U.S., the American entry into the Grand Prix. This is Bloomberg Open Interest. From Ford to General Motors, Cadillac is crashing the Super Bowl to unveil its first F1 car, staking its claim as the lone American challenger, taking on Europe's decades-old dominance. Joining us now is Randall Williams, Bloomberg's U.S. sports business reporter. And Randall, the thing that stands out for this is I've been to a few of these car launches before. And yeah, they're always splashy, but they're not like Super Bowl level of splashy. This feels like something else.
I think when you're an American brand entering a European space, the first thing you want to do is ingratiate yourself in sports culture. That's what they're attempting to do. And look, a Super Bowl ad is among the most expensive of the year. This is owned by Mark Walter, who owns the Lakers and the Dodgers. This is pocket change to him.
So how important is this, though, to Cadillac? I know you're focused on the Super Bowl as you're a big football fan, but I'm focused on the racing, right? And I'm seeing such an incredible expansion from both Ford and General Motors into these massive mega million-dollar series.
It's huge. It's huge. I mean, they are going to be debuting a little over a month later, I believe in Australia and Melbourne specifically. And so with that in mind, they want to build both the brand on the track and off the track. On the track is very simple. You win, you gain fans. And even if you're competitive, F1 is so ultra competitive, we see a lot of the same teams win, or the ones who win those early season races often dominate throughout. But off the track is where it's important, and I think the Super Bowl commercial can help with that.
But it's not even just Cadillac for GM. Red Bull is going to also be using a GM engine too. Yep. How much of this is just like a wholesale re-entry of General Motors into F1, and what does it mean for kind of their overall brand to be so present now in what's had been largely a European sport?
It's huge. I mean, if you think about from the expansion side of things, they paid a $450 million expansion fee. I'm sure that they're going to make that back 10 times over years from now. And with that, part of it is, you think about just sports franchises overall, it isn't just the performance on the track. There are plenty of teams across the NFL, NBA, MLB that have won numerous championships, but their valuations are low. And the reason for that is the real estate play, the branding, the marketing. Cadillac is a big part of this, and them being the only American team in F1 right now is going to do tremendous for their business.
I thought Red Bull was going to use Ford.
Oh, Ford, wow. Motors. So that's what I mean.
You said
Ford.
GM.
I did say GM.
Yes.
Oh, thank you for that correct. But
that's a serious and important distinction.
Wow, yeah, geez. Well, okay, but it does, if I can, defend myself, it just speaks to the presence of American car companies on the track.
Yes.
That's an embarrassing one.
Very big rival.
Very, very big rival.
Yeah. Okay. Really cool stuff, Randall. Great story. Who's your Super Bowl pick, by the way?
Let's go Rams-Bills.
Rams-Bills.
Rams-Bills. Right now, I'm open to changing by the end of the regular season.
I know Joe in the control room wants the Patriots in there.
No, we can't have them.
I would have to agree with you. Bloomberg's Randall Williams covers the business of sports for us. Let's get a quick check on the markets as we come to the top of the hour. Here we have seen again a turnaround in the S&P. These moves aren't huge, right? We were seeing futures that were up by 1 or 2/10% at most, and then down. The down trade was 0.2%. Right. Now we're back up 0.1%. But the interesting thing is the volatility and the quickness in the shift of sentiment.
Well, and the shift was like all due to Microsoft, because you get an information story saying that they're lowering their AI quotas, and then Microsoft comes out and tells CNBC, no, we're not, where things are as usual. But it again speaks to not just the share price volatility, but just to the narrative volatility and the whiplash in deciding who are the winners and who's maybe less of a winner.
All right, very interesting stuff. We're going to continue to suss out for you tomorrow as well. Rebecca Patterson of the Council on Foreign Relations joins us. Lauren Goodwin of New York Life Investments, and Kayla Sater of State Street, plus the Bot Auto CEO. We won't get away from our car coverage. We'll be focused on AVs with them tomorrow. This is Bloomberg Open Interest. Bloomberg Tech starts next.